Our speaker today is Dr. Christopher Thornburg. Christopher Thornburg founded Beacon Economics in 2006. Under his leadership, the firm has become one of the most respected research organizations in California, serving public and private sector clients across the United States. In 2015, Dr. Thornburg also became director of the UC Riverside School of Business Center for Economic Forecasting and Development and an adjunct professor at the school. An expert in economic and revenue forecasting, regional economics, economic policy, and labor and real estate markets, Dr. Thornburg has consulted for private industry, cities, counties, and public agencies. Dr. Thornburg holds a PhD in business economics from the Anderson School at UCLA and a BS degree in business administration from the State University of New York at Buffalo. Please join me in welcoming Dr. Thornburg.
Good morning, everyone. It is very nice to be here. I have done a number of talks for NCSL before, although this is my first time speaking at one of the big events. But they felt they had to invite me, given that you are about 6 miles due east of my office here in Los Angeles. So I should say not only welcome to my session, but welcome to my city. Hope you enjoy your time here. I am, of course, I'm not here to talk too much about Los Angeles specifically. I'm here to talk a little bit about the national economy and what's going on out there. Surely this is, to say the least, an interesting time that we live in. But what's interesting about that comment, when I say the word interesting, to me, you know, we're a little past a decade now from the beginning of the Great Recession. And I actually sort of made my name for myself prior to the Great Recession, because I was one of the few economists here on the West Coast who were actually saying that things were bad and we were going to be tipping into a major downturn. In fact, for a brief period of time, my nickname out here was Dr. Doom, a label I kind of embraced with some degree of enthusiasm, particularly since about a year and a half later I was Dr. Oh, damn, he's right. And of course we know where we are. But I bring that up because, you know, the contrast between now and then, I think, is very acute. Because back then, we were quite calm, despite the fact that when you scratched away at the statistics, you saw all sorts of huge problems happening underneath. Today, to be honest with you, I'll give you the upfront on this, it's almost the exact opposite. We live in a time of political hysteria. When we scratch away at the surface, turns out the economy is about as good as you could possibly hope for. And in as much as that contrast means something, back 10, 12 years ago, the problem was we weren't doing things we needed to be doing. Today, we're doing things we don't need to be doing. And unfortunately, that kind of disconnect between politics and economic realities, to me, is probably one of the scariest things that we are dealing with in this day and age. So my goal here today is to kind of give you that disconnect and kind of walk you through my thinking on some of this. And before I get there, I should tell you what I'm not going to talk about, which is this. Every day, of course, you pick up the paper, the news media is dominated by the conversation around our president. And you know, we live in very contentious times, and you even say the word Trump, and half the room is going to bristle in anger, and the other half of the room is going to want to break out in spontaneous applause. And you know, this idea that he is either the root of all evil or the cure for all our problems, I think is completely misplaced. In fact, I argue in many ways, Trump is not, if you will, a cause, but an effect. This president and his controversy, his controversial place in our society today, is largely driven, if you will, by a deeper degree of partisanship that's been forming over the last 10, 15 years. He is a symptom of the underlying problems. He is not the underlying problem. And I think we need to recognize that. We all need to take a step back and start thinking a little bit more about the broader issue, which is the partisanship that has inflicted this nation. I mean, how far does this go? 30 years ago, I think as a nation we agreed on what the problems were, but we would debate what the solutions to those problems were, and that was healthy. Today, we can't even agree on what the problems are. And it's a really big problem. And I like to say, how far does this go? One of my folks found this cartoon that I thought it was so appropriate. Well, there was Brad with the Democratic weather. Now there's Tammy with the Republican weather. Well, no, I'm here to give you the weather report. And I'm always asked, what are your politics? And I like to point out that I'm a radical centrist. Now, to put that in context, that means here in California, I'm a Republican. In Texas, I will be a Democrat, okay? So that's where I lie. So what is the big picture? Let's just start with the good. The good is the economy is doing great, folks. The economy is doing great. And it's not a new phenomenon. The strength of the trends in our economy have been forming over the course of the last decade or so. Good solid numbers across the board, whether we're talking about labor markets, whether we're talking about incomes, whether we're talking about business investment, whether you're talking about output. There are so many good things happening inside this economy. 2018 took all the momentum we already had and added to it fiscal stimulus. Because remember last year, the one major legislative achievement coming out of the federal government was cutting taxes and increasing spending. We call that Keynesian fiscal stimulus. Now, mind you, we didn't need fiscal stimulus. That's typically something you reserve for bad times, not for good times. But we got it anyway. And of course, the net result of that is we have all this strong growth with the additional boost coming from that fiscal stimulus. It's going to be a great year. 2019, probably going to be a good year as well. Now, I realize saying 2019 is going to be a good year means I'm making a very important prediction. I am predicting that our current second longest expansion in history is soon to become the longest expansion in U.S. economic history. And that's a big deal. I remember a few months ago when, of course, we became the second longest expansion. I think it was in February or March when we officially crossed that time. And there was all sorts of stories in the paper about what a momentous occasion is. And at the same time, I'm sure you also know that there are a lot of people getting nervous. In fact, not too long ago, there was a bank headquartered here in Southern California that I won't name, but they put out a release to all their folks that they're basically pulling in their horns. They're going to back off on lending, and when asked why, the answer is this expansion is so long, it's pretty clear we're going to have a recession any minute now. And I always love that logic. Or you can predict a recession by simply counting the number of months in the current expansion. No, not really. It's a little more complicated than that. Now, when is the next recession going to occur? Well, here's the Wall Street Journal next recession poll. This just came out a few days ago. 2020 is the answer. 2020 is going to be the next recession, folks, according to 60% of Wall Street economists who actually answered this particular survey. Now, I should point out, last year's survey predicted the recession was going to be in 2019. Oh, and by the way, the year before that, the recession was going to be in, work with me, 2018. You got it. All right. Okay. So in other words, the recession's always 2 years away, according to this journal. And that's because, candidly, 2 years is about what a decent forecaster can see. 3 years fuzzy, 4 years pipe dream. So 2 years is about it. So there's no recession now, so it's got to be 2 years from now. And that to me is it's funny. That logic is very funny. In fact, I like to point out, not too long ago, I was received from a different news organization, the same poll, when's the next recession going to be? And I actually wrote back, I'm not going to answer your poll. Because asking when the next recession is going to occur is completely silly. The question you need to ask yourself is, why is the next recession going to occur? Because recessions are the anomaly. You don't just randomly fall into a recession now and then. Recessions are the odd periods of time. The vast majority of the time, the U.S. economy is in growth mode. And when some serious shock hits the system, that creates the economic turmoil referred to as a recession. Well, those are the anomalies, and every recession has a cause. It has a shock. If you don't have a why, there is no when. And I say, look, we're probably good for the next 24 months, candidly, maybe longer than that. I don't know, because I have no reason to think why this recession or this expansion would actually come to an end. There's no reason. And so therefore you can't predict. So yeah, it's still pretty good news. Now, does that mean it's all great news? And the answer is no. There are some breaks, there are some imbalances starting to form in our economy, things you need to pay attention to. Labor shortages are having a big impact on our economy right now. And that's funny, because we continue to be stuck in this 2010 rhetoric. It's all about jobs, jobs, jobs. No, it's not. In fact, right now, we're running out of workers, workers, workers. And that's having an impact on our economy and economy ability to grow. We've had recent market froth. We know the volatility, rising long-term rates. We have an aggressive Fed, fear of inflation. They're pushing up rates, collapsing the yield curve. Of course, we have sharp growth in government deficits going to occur over the course of this year and next year, largely because of the result of the fiscal stimulus. And then last but not least, these global trade and security worries, particularly as, of course, we go through these various sort of trade negotiations with various other countries out there. But of course, the thing that worries me the most, again, is this idea of the growing disconnect between politics and partisan politics in particular and basic economic realities. While we are running around arguing about fixing problems that don't exist, at the same time, very real problems that do exist are going largely ignored. Take, for example, underinvestment in infrastructure, rising wealth inequality, healthcare cost inflation, pension and entitlement reform, all things that are critical for our nation to get in front of now, and we're not. There's not even any conversation about these things. And for me, this is very worrisome because we need to focus on what the true challenges are, but we're not. We're paying attention to the wrong things. So, where are the numbers coming from? Let's just talk about GDP. 4.1% growth in the second quarter. It's a good number, there's no doubt about it. Was it a spectacular number? Well, it was one of the better ones, there's no doubt about it. But keep in mind, back in 2014, in fact, the second and third quarter of 2014, we averaged 5% growth. So it's hardly unheard of, but it was a decent number. Overall, the economy is growing a little less than 3% on a year-over-year basis. You can see on the right-hand side here the kind of the year-over-year growth rate. I like it because it gets rid of the volatility on a quarter-to-quarter basis. Never be too convinced by 1 quarter or 1 month worth of data. It's too volatile. Our numbers are a little too unsettled. But you can see, again, decent numbers where we are right now. Where did the big growth come from in this quarter? Consumption bounced a lot. In fact, one of the biggest surges of growth came from consumer spending. Consumers almost added 2.7%, but that was on the basis of a very weak first quarter. In other words, kind of getting back to return to normal trends in consumer spending. That's going to cool off just a little bit in the third quarter. Fixed investment was great in 2017. It's continuing those trends into this particular year. Good spending on structures and equipment. And then last but not least, government actually, especially the federal government in terms of national defense, added a lot to growth in the second quarter as well, again getting back to that fiscal stimulus plan. So lots of things moving us forward at this point in time. Let's talk about industrial production and business investment in general. Very good numbers there, overall growing about 3% on a year-on-year basis. We had a big slowdown in 15 and 16. This was driven by the global commodity bust that slowed our economy down. Remember the big collapse in oil prices, the big slowdown in oil exploration. Well, the big bounce back we're seeing right now is also on the basis of commodities. In fact, mining over the course of the last year grew 13% in terms of its output. That was the majority of the big surge there. Utilities up were about 5%, manufacturing only up by about 2%. So manufacturing moving again, but still not that much, if you will, in the growth mode. This is largely a mining phenomenon that's going on out there right now. What's driving mining? Well, it's oil. We are in the midst of an oil revolution, really unbelievable. Right now, the U.S. is producing 11 million barrels per week. 11 million. Put this in context, this is twice as much as we were producing in 2008 when it was 5,000 barrels. This is higher than ever before. Right now, the United States is by far and away the largest oil producer in the world, producing 20% more per year than Saudi Arabia and 25% more per year than Russia. We're on an oil roll like nobody's business. And of course, this is all being driven by fracking. Fracking has completely revolutionized oil production to levels it's really hard to even appreciate. But let me help you appreciate it just a little. On the right-hand side here, this is U.S. drilling activity. This is actually the amount of effort, if you will, being put into putting new holes in the ground. What's amazing is you can see the huge surge of drilling activity coming up through, say, 2013, 2014. A big collapse with a commodity bust. Right now, new drilling activity is not even half of what it was back in 2015, and we are at record levels of oil output. So remember that this is all about the efficiency of existing wells. Now, where is oil going? Where are oil prices going? Prices have drifted up. They've gotten into the $70 range recently. But I think myself, like a lot of economists will tell you, this is not a sustainable level. You know, the sort of standard number right now is $50 a barrel. Fracked oil costs about $50 a barrel on average, and we have massive quantities of frackable oil out there. Just a couple of years ago, they found the Wolfcamp Shale out in West Texas. 20 billion barrels of oil. 20 billion. Plus countless amounts of natural gas as well. This will come online as soon as they get that pipeline built across Texas, which, if you've been to Texas, it should only take them a decade or two. It's a big state, you know? That was a joke. It'd be quicker than that. But anyway, but obviously, when some of the pipelines get connected, yet again, more of these resources coming online. Now, for those of you who are worried about global warming, you should worry about it, but at the same time also recognize the solution to global warming are incremental approach. And incrementally, this is good news because, remember, fracked oil is a lot cleaner than, say, tar sands. And as a result of that, on net, this is good. And when you think about the death of coal, it's natural gas that's been creating that problem, not, if you will, regulations and rules. And that, again, is on net a positive for the economy. So cheap energy, incrementally good for the environment. We should be pretty happy about this, and it's just a matter of continuing to ride this as we go forward. But again, if your state's relying on oil revenues, I wouldn't expect them $70 a barrel being in place for a long time. Almost assuredly, this market's going to get flooded with new supply, and they're going to start drifting back down again. Which, of course, brings me to the other side of the equation, because remember, the U.S. is actually becoming far more energy efficient. Over time, because of more fuel-efficient cars, because of changes in building technology, because of investments in various sorts of energy efficiency standards in homes, actually energy consumption relative to economic output for both petroleum and electricity continues to fall. And one of the interesting outcomes of this, of course, and this is again something that all cities and states should be paying attention to, is right now capacity utilization in the U.S. utility industry is the lowest it's ever been. There are massive stranded asset problems in the utility industry, and these are going to be readily apparent over the next 5-6 years, particularly as more and more solar comes online, which again is eating away at the business, because cheap natural gas is wiping out nuclear and nuclear's ability to compete. It's going to be some interesting times, so everybody should be taking a good, long, hard look at your local utilities to see just how long they're going to be financially sustainable. It could get really ugly in the next 5 to 6 years. Pay attention to that. Exports have also been a decent source of growth for the U.S. After a bit of a slowdown in 14 to 15, they've hit a new record high. Nominal trade flows across from industrial supplies, travel's up, automotive is up, food and feed is up, civilian aircraft is up. 26% increase in petroleum product exports. That, of course, has to do a lot of the refined exports going back to, again, this huge glut of oil and gas we're producing. All good numbers across the board here. And it's only going to get better, because as strong as the U.S. economy is, the global economy is doing well as well. Overall, they're expecting about a 3.9% growth over the course of this particular year. And it's interesting because the dollar is still relatively strong compared to what it was a couple of years ago, but exports are still growing anyway. Again, in large part because the strength of the global economy is such that our slightly higher prices don't mean as much relative to the increases in demands. So very good numbers on this particular front. Exporters have a wonderful world to go and sell products in. But of course, as good as exports are, we also have the issue with the trade deficit. Now, we do need to talk a little bit about the trade deficit. It has been an issue. It has started to widen. You can see the trade balance on the left-hand side here, how it's been drifting down. Not quite as bad as it was back in 2006, but pretty close to it. And one of the questions is why? Well, the wrong answer on this is that trade deficits are created by foreign trade barriers. In fact, most folks would note that trade barriers in general tend to reduce the amount of trade. They don't have a lot of influence, if you will, on the actual balance of trade. And that's because the thing that drives the balance of trade has a lot more to do with internal conditions in the United States rather than external conditions. More to the point, the way to think about a trade deficit is as the difference between what we as a nation consume relative to what we as a nation produce. When we are consuming more than we're producing, that additional consumption has to come from somewhere. It comes from the rest of the world in the form of a trade deficit. We're importing more than we're exporting. Equivalently, if you're a nation like Japan, that actually consumes less than they produce, they run a trade surplus. Now, the big question there is what causes the gap between consumption and production? Well, that all has to do with savings rates relative to investment. The argument is, if you don't save enough to meet your investment needs, you're borrowing money again from the rest of the world, which is the opposite of trade deficit. It's a current account deficit, it's a capital account surplus because money's coming into the United States to buy up our assets. So the real issue is, when you think about this trade deficit that began in earnest back in the early 90s, on the one hand side, take a look at these two big graphs. One is net national savings, and the other one is net exports. And take a look how these two lines have both been falling continuously for the last 30 to 40 years. When you ask why are we running a trade deficit, it's because we as a nation don't save enough. And that's true at the household level, because household savings rates are actually too low at only 6.5%. And of course, government savings rates are also very low. We know the federal government, a lot of state governments continue to borrow on an annual basis. The lack of savings is what's causing us to have to borrow from the rest of the world to have to run this particular trade deficit. Now that's important because, of course, when you start hearing about conversations about trade policy, and those trade policies are wrapped around the idea that the trade deficit is bad for the United States and is being created by foreign trade barriers or foreign unfair trade practices. In reality, again, most economists don't agree with that particular view. Now, this gambit opened up, of course, with conversations about tariffs on steel and aluminum. And it was an interesting place to start. Why a tariff on steel and aluminum? Steel in particular, why would we start there? Now, you've heard all sorts of stories about how our U.S. steel industry has been absolutely clobbered by foreign imports. And it is true that imports have been gathering market share, but the actual high watermark, if you will, for foreign imports occurred back in 2014 and 2015. In 2014 and 2015, about 1/3 of all steel consumption in the United States was supplied by foreign manufacturers. So in other words, never in the history of the United States has less than 2/3 of consumption in the United States been actually met by U.S. producers. So the steel industry is actually out there, and over the course of the last couple of years, the steel industry has actually been clawing back market share. The most recent data back in 2016 suggests that about 70% of all steel consumed in the United States was produced in the United States. That's a pretty good number. They're doing pretty well. Of course, prices have been rising, which means they're making more money. There's new steel mills coming on. The industry is actually pretty healthy. So it does beg the question, why are we so worried about the steel industry? Now, the steel industry would tell you it's because of all the jobs that were lost. And the steel industry was all about this, and they were out there telling stories about how entire towns in the Midwest were being wiped out by the scourge of foreign steel. I beg your pardon, but the entire steel industry, the entire base metals industry in the United States, the entire thing, lock, stock, and barrel, hires less than 100,000 people per year right now. To put that in context, if you banned imports of steel, just banned it outright, you might create 3,000 to 4,000 new jobs in the U.S. On an average month, as a nation, we produce 150 to 160,000 jobs. 4,000 jobs is it's a drop in the bucket. It's not really worth even talking about. So from my perspective, I sort of took a step back and why here? I don't understand. Well, just to help the trade deficit. But again, remember that steel and aluminum is less than 1% of imports. It's not a big number. Why here? What is this about? And I never really understood the answer to that. There hasn't really been any good answers. This, of course, is coming out of Peter Navarro, who, by the way, is a Southern California creation out at UC Irvine. And this was his big thing. Now, of course, the big issue here is not, this doesn't mean much one way or the other, to be honest with you. It doesn't change much of anything. Doesn't create a lot of jobs. It's not going to change the trade deficit. What it is going to do, of course, is upset our trade partners. And lo and behold, of course, Trump said in his famous tweet, trade wars are good and easy to win. I'm not sure on either one of those particular comments. But where it gets a little scary is let me catch what the European response was to this move. The we could also do stupid. Seriously, this was their tweet. Now, again, let's think about this. Actually, they were a little smarter. Look, if you're going to slap a punitive tariff on a foreign country, you don't go at a commodity. Because if you put a tariff on a commodity, what ends up happening is that simply gets passed on through the supply chain, ending up as higher prices for consumers. Now, mind you, the numbers we're talking about are pretty small. I mean, you know, a few cents per can or $40, $50 per car. They're not that big. But that's where it ends up, with Americans end up paying that price. On the other side of the equation, when the Europeans started talking about tariffs, they went after name brands. They went after Levi's. They went after Harley-Davidsons. Why? Well, name brands, there's no supply chain. That's going straight to the consumer. So Harley-Davidson has a choice. You either cut your price in order to stay competitive in the European market and then thus lose profits, or you lose a bunch of market share and lose profits. So in other words, slapping a tariff on a direct consumer product is a much smarter move from a punitive standpoint, and that's where they went. Which, of course, is why I think eventually we ended up with this, where, yes, we are now at peace again with the European Union. We're moving forward to a new trade partnership with them, which, by the way, sounds a whole heck of a lot like the transatlantic trade pact they were trying to put together at the end of the last administration. So what goes around comes around. Here we are, and I'm glad. This is a positive movement. I'm glad we're moving forward. Now, when it comes to China, here I have a lot more sympathy for what the administration's doing. It's about time somebody stood up to the Chinese. Look, they don't play fair in the global trade sandbox. They steal intellectual property rights. They give very unfair, unlevel access to American businesses trying to invest in their country or sell in their country. They exert all sorts of punitive efforts on those particular companies. The old joke goes, there's two kinds of companies in China. There are those that lose, there are two kinds of foreign companies operating in China. There are those that lose money, and there are those that make money and thus having it taken away by the Chinese government. That's the only two kind of companies operating in China. And so yes, standing up, saying enough is enough, you have to start playing fair. I completely applaud this. As long as we have what I would call really concrete, sustainable goals. Here are things you need to do in order to head this off. Some of these goals we've asked for are a little bit weird to me, like, for example, asking for a unilateral $200 billion cut in the trade deficit. That's a little odd, because as much as the Chinese do have an influence on these things, they don't actually control the trade deficit. It's not like there's a big lever in Beijing you can move back and forth. It still is a private sector enterprise of buying and selling goods. It's not clear you can do that. But other things, such as, again, guarantees of equal access for investment, guarantees of intellectual property rights, I'm all good for this, and I'm glad it's happening. Will the Chinese back down? I think they will. Yes, they put up a lot of rhetoric about this, and this morning they sent out a bunch of messages as well about this potential expansion of the tariffs. I would point this out. This is probably the most important thing you need to know. 0.75% of the U.S. economy goes to China on an annual basis in the form of goods. On the other hand, 4% of stuff produced in China comes to the United States on an annual basis. And when we think about that 4%, the supply chain effects through China are much larger than the supply chain effects here in the United States because of the quality and composition of those. For example, where the 0.75% of our GDP goes over to China on a regular basis, a lot of that's garbage and recycled products, things that don't have supply chain effects per se, except for if they stop buying it, it starts piling up in our ports. In contrast, when you think about any of the goods that come over here from China that are assembled, it goes down the line in many different ways, in many different parts of the Chinese economy. They don't want to have this fight. And they're almost assuredly desperately looking for a way out where they can maintain face. And I think that's going to be the rub on this entire negotiation. So I'm glad we're doing it. I hope it works out. And as long as it stays restricted to China, it's not going to be that big of a deal for the U.S. economy. We can muscle through this, even if it gets ugly. If it goes global, if everybody starts launching tariffs at us, we have a problem. But if it's just China, we'll be okay. We'll get through this all right. How about consumers? How are they doing? The answer is pretty good. Overall spending continues to grow a little less than 3% in real terms on a year-on-year basis. Solid numbers there. Auto sales have been staying nice and steady, running about 17 million at a seasonally adjusted annualized pace. A little up and down, not to be surprised, given the kind of stock flow effects in the market, but decent numbers here. Last time I had this conversation, the last year and a half, we've been warning people that we have a big problem with the consumer sector. As strong as the numbers are, I saw a really worrisome downturn in savings. And in fact, you can see on the left-hand side, the Q1 numbers, savings had been at 6%, they had dropped to 3%. Last time they were that low in 2006. Well, here's one of the challenges of being a forecaster, because not only do you have to forecast the future, but you often have to forecast the now, because the BEA likes to shift up on us. The second quarter came out with a big number of releases, most which were fairly minor, except for one huge change, which was a change in personal income. They actually upped their estimates of personal income growth, particularly for sole proprietorships. Apparently, small companies are doing much better than they expected. They updated their methodology. They increased those numbers a lot. And lo and behold, the savings problem went away. No more savings problems. Now consumer savings live nice and steady, still running about 7%. Overall incomes look better for consumers. Decent numbers here. Really, households are about as financially stable as they've been in a very long time. You look at debt-to-income ratios, it's running about 90% right now, nice and stable. They were about 115% back in 2007 before the big collapse. And the quality of this credit is pretty good as well. If you look on the right-hand side, this is transition to 30-day late. This is new delinquencies. So in other words, it's telling you not about former problems, new problems in the markets. And there really aren't any. Mortgage loans are about as clean as they've been still in a very long time. Even student loan delinquencies have been falling. Credit card delinquencies bounced up just a little, but they're lower than at any time prior to 2013. And yes, auto delinquencies drifted up just a little bit as well, but that's fading away. It wasn't as big of a deal as the press would have you believe. Consumer credit markets are really good right now. In fact, the overall financial obligation ratio, which is the share of household income going to support financial needs, whether it's paying your mortgage or paying your rent or whatever the case may be, is still near an all-time low level. So the numbers here again suggest nice, steady growth in this part of the market. Housing, same sort of thing. I mean, sales, they drifted down just a little bit, running about 5.4 million, but they've been nice and steady. Month supply of home is still very tight at this point in time. Month supply of home is probably your best indication of coming problems in the real estate market. If you look back at, to say, late 2005, you could really see the huge surge in the month supply of homes. That was the first indication that all hell was about to break loose in the U.S. real estate market. This was one of the reasons why in 2006 I was so confident in my predictions. Today, overall inventories, month supply is still about 4 months. This is an exceedingly tight market right now, which is funny because when these numbers came out, did anybody catch these crazy headlines that started popping out of the news? All over the place. Oh, it's the end of the world. The housing market showing signs of cracking. Anything goes. List price strategy is no longer working. It's amazing to me. It's amazing the ridiculous screaming headlines we have to deal with on a day-to-day basis that just have no semblance. I don't even know where this comes from. I can't possibly imagine where this journalist comes up with this stuff. The numbers aren't that bad. Take price growth, for example. Price growth really isn't even all that heady. We're talking right now, something in the order of about 6% on a year-on-year basis for the nation. Some markets are hotter. Seattle is super hot right now, been hot for a couple of years. Vegas is heating up. San Francisco, again. Some other markets, Cleveland, Miami, New York, a little more moderate right now. But overall, none of these numbers scare me very much. Do we have a real estate bubble at all? Not really. Well, what about these rising rates? Are they going to hurt things? Well, first of all, let's be clear. Yes, mortgage rates have come up just a little bit. They're in the mid-4s. That's still the lowest they've ever been any time before 2009. I mean, how many times have you had someone in your family tell you about that 14% mortgage rate they had to pay back in 1984? I got one more time about the 14% mortgage rate. I'm going to, come on. These are really low rates. And in fact, if you look at the buy-in ratio, which is the cost of putting 20% down first-year mortgage and taxes, it's still actually relatively good. Rates are so low today that the buy-in ratio is still good. There's nothing wrong with our housing markets. None of these numbers scare me whatsoever. Mortgage market's still tight. I always like to say, if you think there's a bubble, there's only two kinds of real estate bubbles you can have. You're overbuilding or you're overborrowing. If you think it's a bubble, why? Are you building too much or are you borrowing too much? Certainly not borrowing too much. Right now, mortgage debt is only growing by about 4.5% on a year-on-year basis. That's slower than price appreciation. In other words, the leverage ratio in American real estate continues to fall, not rise. So certainly this is not a debt problem in a classic sense. Indeed, if anything, one would argue that the problem in our mortgage markets today is debt is too tight. The actual qualifications to get a mortgage is very stringent. This is the pendulum going too far the other direction, given what happened in the subprime disaster we were in. Overall, a lot of folks haven't been able to jump back into the market. There isn't a lot of borrowing out there. Things seem pretty steady to me. As for the pace of construction, a lot of folks out there think that the numbers are too slow. That right now we're building about 1.25 million units. A lot of folks were expecting about 1.6 to 1.7 million units. I didn't expect that much, and I'll tell you why. It is true we are building less now than we did, say, 20 or 30 years ago in the midst of a housing expansion. But it's also worth noting that population growth is a lot slower now, too. If you look at housing starts per new household, we're right in that kind of Goldilocks zone. We built way too much in the middle part of the last decade. We had years of underbuilding, allowing, if you will, population to catch up with the stock, and now we're right back to normal levels. There's nothing to see here. The markets look just fine. Won't worry too much about this. Well, yeah, I guess this is what we're talking about. The only thing, again, that should be something we should all be considering is home ownership. You know, after years of big increase in home ownership rates from the early 90s to the middle part of last decade, they, of course, collapsed after the Great Recession kicked in. They are starting to grow just a little bit. That's a positive sign. I'd like to see them grow a little faster, but in general, I again, don't see much here to worry about. Things are just fine. Labor market's still good. Last year, we added about 2 million jobs, not a great number. Overall employment growth running about 1.6% on a year-on-year basis. A little better than, say, in the middle of 2017, but not quite as good as back in 2014. Things are good. Not great. You're not seeing a huge amount of job growth. But when you say we're only seeing 1.5, 1.6%, that seems a little weak. Why? It isn't necessarily because of a lack of jobs. In fact, we have a new survey out. It's called the JOLT. It's been out for about 20 years now. The Bureau of Labor Statistics does. And it's an estimate of the number of job openings in the U.S. economy. Right now, the job opening rate is about 4.1% in the U.S. That is to say, the number of job openings is 4.1% of all the jobs out there. The unemployment rate right now is 3.9%. For the first time since they created the survey 20 years ago, there are more job openings in the U.S. than there are people looking for work. This is a momentous occasion. Everywhere across the United States, businesses' biggest problem is, I can't find anybody to work for me. You see help wanted signs everywhere. Some states are paying people to move there because they can't get employers working. This is a big deal. Now, if labor markets are this tight, why aren't wages going up? This has been one of these quandaries that I pick up the paper all the time. Why aren't wages going up? And the answer is wages are going up. It's just that newspaper reporters don't know how to look at data. The raw data you get from the Bureau of Labor Statistics is not very good. It's not good because of problems in the survey. It's not good because it's not inflation adjusted. It's not good because it doesn't account for the fact that high-paid boomers are retiring en masse. You have to take these things into account. The Atlanta Fed has a thing called the wage tracker where they clean up these problems. And they look at numbers which is year-on-year growth for workers who have been continuously employed over the course of the last year. Well, that number suggests that on real wage gains, on average, are running about 3.7% right now for people who are in the workforce. That's a great number. That's on par with where we were in 2006. It's better than 2004. The median wage gains run a little less than 2%. Not about the same as where we were back in 2003, 4, 5, 6. These are good numbers. These aren't bad numbers. Look at the average cost of an employee hour for employers. This includes, of course, benefits, including health care. That's been running 4%. Because on top of the take-home pay, there's also the increased cost that employers are paying for the benefits people are taking with them. These are good numbers. People are earning more. And it's amazing to me that people continue to have this idea that Americans are falling behind. Every time, not too long ago, some book was written, and I remember, you have to double down. During the election, it was, Americans haven't gone to raise for 15 years. This guy written, middle-class Americans haven't seen a pay raise in 40 years. Oh, how about this one? This is one of my favorite one-liners of all time. Millennials will be the first generation to have a worse standard of living than their parents. Have you heard this? How can you say that out loud without giggling just a little bit? Really? Millennials are going to have a worse standard of living than their parents. What a preposterous assertion. And I'm not talking about the snowflake phenomenon. Put that to one side. Just look at the quality of life a standard millennial has and compare it to what you had when you were that age. And you think, how can you possibly think these kids are going to have a worse standard of living than you? But these are the things we talk about as if it's real. Now, part of this comes out of this data. You can download this off the census webpage. I love this because it so wonderfully encapsulates what's wrong in our political debates today. This is real average household income. Comes right off the census webpage, and it shows a fairly disturbing pattern. It grew from 70 up to about 2000, and from 2000 to 2014, it went down. And you look at that and go, oh, that's not a good trend. That's where that whole millennials are going to have a worse standard of living. You know, they just put a straight line to that, assume it went down. And then, of course, the last couple of years it's gone up, so you don't see here too much of that. But even here, it suggested incomes in 2016 only a little bit above where they were in 2000. Does that make any sense? Does anybody think that people's standard of living is actually the same in 2016 as it was in 2000? That doesn't even make any sense. But of course, it becomes the center of these debates. And you will find this picture on 1,000 right-wing web pages. When the right-wing web pages will tell you it's because taxes and regulations are screwing the middle class. And then you'll find it on 1,000 left-wing web pages. And they will tell you it's because rich people and corporations are screwing the middle class. And the answer to this quantity, this debate is very simple. The data's wrong. Because you've got to look at your underlying source of data. This data comes from your adjusted gross income numbers on your IRS form. Now let me be clear. For those of you who don't have a degree in accounting, your adjusted gross income is in no way, shape, or form your income. There are massive amounts of income on there, from public health care to private health care to various sorts of other government benefits, to pension benefits, to anything you write off your taxes because you have kids, for example. All of this is income that's not included in your adjusted gross income. Now, we have another source of data. We can go to the BEA and get a full measure of income, plop them in here. What does that look like? Oh, damn it. Sorry, taxes, regulations, rich people and corporations, you may leave now. You are no longer a suspect in a crime that didn't actually occur. And this is crazy, right? But this is what we debate about. Now, mind you, even this doesn't capture it because these income numbers are a good correlation with quality of life, but they're no perfect metric. Our measurements of U.S. true happiness, of our true prosperity, are limited. We do the best we can, but there are lots of ways that aren't included in these numbers that lives are better today for millennials than they were when I was a kid. I like to point out, what's better today than 25 years ago? And the answer is kind of like everything. Communications, right? I have little kids at home now. I made some weird choices in the later years of my life, but I have little kids at home. And, you know, Grandma lives in Japan. 25 years ago, she would write a letter. Oh, you know, how are the kids doing? It would, you know, if a millennial was here, I'd have to explain what a letter was to them. But anyway, you know, or do you make a phone call, 30-second phone call? Hey, are they alive? Yeah, great, love you, Cliff, like $30, right? And now she has an iPad, we have an iPad. We FaceTime, and she plays with her grandson for an hour. They didn't have that in Star Trek, for God's sake, people. They had to talk into a plastic toy. They didn't have, we have faces, right? It's crazy. And none of this is in the numbers. Medical care. Yeah, I know it's expensive. We have problems with insurance, but the quality of medical care is insanely good compared to what it was 25, 30 years ago. Every day, new things, new procedures, new ways of doing things make us happier, live longer forever. I mean, nowhere in the GDP statistics is a measurement for the value of Viagra as had for our economy today. Put that in the back of your mind, okay? I don't know what that number is. Maybe some people just think it's a negative, but I don't know. But just saying. Entertainment options. When I was a kid, remember 4 television stations? Now people are cutting the cord because they have so much stuff on their stupid phone. Transportation like never before. Shopping, product quality. I got big feet. I got 15 wives. As a child, trying to find shoes was a nightmare. So no, we don't have. No, we don't have. No, we don't. Yes, we have one pair of the ugliest shoes ever designed in the history of big men's shoes. Now I go on the internet. I buy whatever I want. Now I'm like, oh, if it doesn't get here in 2 days, I'm not buying that. I used to spend 2 days finding the ugliest pair of shoes known to humanity. None of this is in here. Food quality, variety, access to information like that before. The environmental conditions are much better. The air is clean. Yeah, we have problems, but things are much better than they were when rivers were on fire in Cleveland, right? Things are much better. My favorite, legal marijuana. Welcome to California. Make sure you take a bag or two home to the kids, folks, okay? Bring it on the plane, no problem. What isn't better today than 25 years ago? What isn't better, honestly, in ways we don't count? And the answer is traffic and the stones. Everything else is better. Everything else is better. And we don't think about it. It's crazy. We don't think about this stuff. It makes me crazy. What about inequality? Even here, there's a huge misinformation campaign going on. Look, yes, I understand inequality. These are Gini indices, okay? And these are tracked over time, and if you look at raw data based on market income coming out of net adjusted gross income, yeah, inequality is getting higher and higher. The Gini index is 0.6. That's a false number because it doesn't include benefits received. It doesn't include taxes paid. If you look at inequality after all transfers, after all taxes, not only has it not been growing as fast, it's nowhere near as high as the market numbers do. To be honest with you, at 0.44, we're roughly where we were back in 1986. Inequality of income is not that big of a deal, yet it's become the single-minded obsession of our nation. You know what scares me? Inequality of wealth. This worries me a lot. Right now, 2016, the top 1% owned 40% of all American wealth. Back in 1989, it was 30%. And this probably doesn't even tell them the whole truth, because who knows how much this stuff is packed off boards. And if you go to the top 1%, it's even more stilted. So you have more and more agglomerating to fewer and fewer people. And anybody will tell you this is not healthy for a functioning democracy. So stop talking about income, start talking about wealth. That's where the problems exist. But we're not talking about it. And overall, when it comes to jobs, let's take a long view. Because I always love this idea that we're gonna run around and toot our horns or scream and holler about whether it's 140,000 jobs or 180,000 jobs or 210,000 jobs. When in reality, when you look over long term, here's where we are. We're growing less than 2%. And that's been pretty steady since the late 90s when we were growing in the mid 2s. And of course, compared to the 80s, we were growing in the 3s. If you look closely, get rid of the business cycles, this is downward sloping. Why? Well, it's not, again, regulations. It's not problems in labor markets. It's not mismatches of skills. It's not automation. It's the fact that we're not growing our workforce very much. You know, look at that big downward slope in overall labor force growth, right? Used to be high in the 2%, slower. Over the last decade, it's been growing not even 1%. And yes, I know participation rates are still low, but why? The answer isn't because of a lack of jobs. The reason, of course, is because of boomers. Yes, it's boomers. It's all your fault. Everything is your fault. Just so we're clear on this. Rick, are you listening over here? All right. Rick works for me. He's our in-house boomer. I have to yell at him every time I do this stuff. Look, on the right-hand side here, this is important. This is a very simple social sort of model I have in my head. Every boomer was raised in a family of approximately 16 kids. They were also horribly traumatized by this experience, and they all had 1.6 kids, which they excessively overparented, thus giving us the millennials. See how that works? Right? And us Xers, raise your hand if you're Xer. Power brothers and sisters, we are in the middle. We are in the middle. And we have to deal with all this. But putting aside the social implications, the economic implications are enormous. We had a population pyramid, now we have a population column. It is true, millennials are the biggest generation ever. They're 2% bigger than the boomers. And the boomers are now retiring. Over the last decade, because of this phenomenon, the growth of 25 to 54-year-olds, people who are in the prime working age, hasn't grown at all. It's been flat. And you wonder why we can't add a lot of jobs. There's nobody to fill them. We need more population growth. It's as simple as that. We need more people. Now, that's why last year, the Congressional Budget Office put out a big report. They said, how do you make the U.S. economy grow faster? How do you deal with the issues of secular stagnation? Number 1 and number 3 on this, by the way, is enact immigration reform to increase the number of workers and increase the Social Security retirement age by 2 years. More immigrants, less retirement. More people working longer. That's how you fix this. By the way, a lot of people taking pictures. You can download this presentation at beaconecon.com later on if you'd like to get this data. It'll be there for you. So this is pretty straightforward. Now again, let's start with a conversation about immigration. I am happy to have a debate about how we have immigration. Securing the border, who comes, whether it's skill or family-based. I'm happy to have those debates as long as in the end we reach a conclusion at which we're going to change how people immigrate to this nation and make the number larger. And my fundamental problem again with this administration is not left versus right, Democrat versus Republican, I don't like Trump, none of that. It's the idea that they want to shrink immigration. And I recognize that if you want this economy to continue to grow as fast as it has been, we need more bodies doing more jobs. If you don't want more immigrants, fine. But acknowledge the consequence of that is going to be a slower growing economy. It must be. So let's have an honest conversation about what's really going on here. But this idea we're going to make the economy grow faster and have fewer immigrants, that doesn't add up. It doesn't work. It doesn't flow logically. So we have to have real conversations about this. And of course there are consequences. Corporate profits are going to get hit because wages are going up. But on the other hand, think about all that new business investment. I'll tell you, a lot of this new business investment is occurring because they don't have workers. Everybody's all worried about automation. I'm like, hey, automation. It's exactly what you need if you don't have bodies. I love it when they get automated cars because think of all the people it's going to release to go fill some of these job openings we had inside the U.S. economy. This is a good thing. Plus, living in L.A., it's a really good thing. So, there's a couple other things up here as well. One of them is reforming the income tax code and reduce deficits. Now again, going back to last year, we did have a big fiscal package put in place. And I would love to tell you that we in fact reformed the income tax code and we reduced deficits. And unfortunately we didn't. Now what do I mean by reform income taxes? That's important. We live in a democracy. You're all part of that. You're state legislative folks. You understand how this works. And in a democracy, there are constantly special groups, interests, forces pushing for special provisions. We want a special tax break here. We want a special tax loophole here. I want a special exemption here. This is what they do. Sometimes they have good reasons for it. More often than not, they don't. And one of the results of this is over time, because of the forces of these political interests, the tax system can become very out of whack. Where we undertax certain parts of the economy and we overtax other parts of the economy. And this is recognized as a problem in the academic literature. We understand this. When you go back to Reagan, you ask, what did Reagan do? Why was Reagan so successful accelerating the growth of the economy? It wasn't because he cut taxes. It was because Reagan and Tip O'Neill got together and reformed taxes. What they did, making a flatter, fairer system, was enormously powerful to the U.S. economy. And we desperately need that today, a flatter, fairer system. All for it. And a classic case of this would be corporate taxes. The statutory rate on corporate taxes was 35%. Too high? Way too high. Needed to come down? Absolutely needed to come down. But the effective tax being paid was 21%. Because for every company paying in the 30s, there was someone else paying in the single digits if they were paying at all. And most of these guys who are paying way less than they should have are companies making money hand over fist. Now, I'm from California, which means I'm, of course, going to immediately point at the big oil companies in Texas. But I will also tell you, so don't rat me out to my California colleagues, okay? But this also includes a couple homegrown heroes like Google and Apple, which are paying minuscule taxes on the gazillions of dollars these guys. Did anybody catch Apple's last reports, how much money they made? Go look at what they paid in the form of taxes. It's obnoxious. Clearly, certain groups in our economy should pay more, and a lot of other people should be paying less. We didn't do that. we cut taxes, we didn't get rid of loopholes. And of course, on top of everything else, they then, of course, increase spending. What you have is a fiscal stimulus plan. This is clearly going to cause a big increase, and already is causing a big increase in federal spending. Now, is that critical? The answer is no, not really. I kind of shrugged. Because the reality is, we already have a big problem. Remember all those boomers that are on the edge of retiring? You know, over the next 20 years, we're going to be adding 31 million people to the Medicare, Medicaid, and Social Security rolls. Excuse me, not Medicaid, but Medicare and Social Security. We're going to go from having 47 million to 78 million people in retirement age. It's almost going to double in 20 years. That means in 2015, Medicare all by itself ate up 18.7% of the federal budget, keeping things in context, keeping things steady in terms of growth in spending, growth in revenues, everything else. In 2035, it's going to eat up 41% of the federal budget. What this program did was it took a bad problem and made it a little worse. We were already going to be, at the end of 10 years, borrowing $10 trillion. Now we're talking about borrowing at the end of 10 years about $13 trillion. But I tell you what, from somebody who understands that in 10 to 12 years, this is going to become critical, it's not good moving in the wrong direction. I'd like to think that we could start acknowledging this is a problem and moving in the right direction. Instead, we're completely ignoring it as if it isn't an issue, or if it is an issue, it's nothing we need to worry about right now. And eventually, this is going to catch up. When? Not now. You know, here's another thing. Every time you turn around, there's somebody talking about how the federal debt is 110% of GDP. It is not 110% of GDP. It's not even close to that. Because remember, a huge amount of federal debt is actually owned by the federal government. It's either owned by the Social Security Administration or the Federal Reserve. And that's taking money out of one pocket and putting it in another. It's not real debt. Net debt to GDP right now is about 70%. At the end of these 10 years, it'll be 90%. So what? The funded liabilities are irrelevant, and the increase in funded liabilities are, for now, irrelevant. But at 10 years to 12 years, when this gets into the 100% range, when, of course, Medicare spending is going through the roof, that's when we start getting in the crisis situation. Remember, it's not the funded liabilities you need to be scared of, it's the unfunded liabilities. And that's not what we're talking about at all. And, of course, the states need to have the same problem as well. Not only, of course, the states have all the pension problems, and you all know about that, and you understand exactly what the dynamics are. Overall, right now, the funding ratio in the U.S. is about 66%, according to the Pew Charitable Trust. By the way, because of a bad year in 2016, it dropped by 5.7 percentage points. I think it came back a bit in 2017. 2017 was a very good year, and a lot of pension funds made some of that up. But it's still really undervalued, and of course, more and more states are reliant on the federal government, so you're going to see this come to play as well. Right now, about 23% of all revenues come from the federal government, state and local level in the United States. That's up from 18% back in 1999. So these problems are very much going to hit home, even as they're hitting Washington, D.C. Pay attention to this, not to be healthy. How about the markets themselves? Where are they? Well, of course, it's been kind of a crazy year. Interest rates have been tipping up. The stock market has been volatile. It's barely up from the start of the year. A lot of folks in Wall Street are wondering what's happening out there. A lot of folks are talking about the Federal Reserve and what they're doing. What is going on? Well, I've already talked a little bit about interest rates. As I noted, of course, interest rates are not all that high. I'm just trying to think what the time was. Okay, good. Yeah. Interest rates are not really all that high, while they have come up just a little bit. As for the stock market, while the stock market has been flat since the start of the year, it's still about 8-9% from where it was last year. So you're still ahead of the game, even with a little bit of volatility. I'd be a little cautious about calling this any kind of major market problems we're seeing out there. But nevertheless, the Federal Reserve is the center of the conversation right now. And I've been a big fan of the Federal Reserve for a long time. I think they did a masterful job working us through that Great Recession. However, nowadays, I'm a little less sanguine. Now I'm a little curious, because as you know, the Federal Reserve continues to tighten short-run rates, continue to push that federal funds rate up. And as a result of that, they are flattening that yield curve. Now, the real question here is why? Why is the Federal Reserve doing this? You know, one of the comments I've heard is normalization. Well, the Fed's currently normalizing interest rates. Really? All right. look on the left-hand side. You can see that back in 1982, the federal funds rate was in the double digits and the 10-year bond rate is double digits. Today, the federal funds rate is 2%, the 10-year bond is at 3% rate. What's normal here? Can anybody point to me and tell me what normal is over the last 30 years? Normalization doesn't make any sense. What isn't normal is a 100 bip spread between long and short run rates. That's not normal. Now, you wonder why I'm so worried about spreads. For those of you who aren't sort of inclined to pay attention to this, an inverted yield curve, which is to say when long run rates are actually lower than short run rates, when you have an inverted yield curve, that's actually the best indicator of an oncoming recession. The last 9 recessions were all preceded by an inverted yield curve. And seeing that inverted yield curve getting closer and closer to zero, from the economist's perspective, you're like, that doesn't look very good. Now, it isn't to say that an inverted yield curve causes a recession, but it certainly is associated with various sorts of economic problems, and certainly not, it's not a theory I want to test. If you invert the yield curve, will we have a recession? Not sure that's something you actually want to test. So what are you doing here? Well, they're worried about inflation. This, again, to me, is something that I can't quite get my head wrapped around. Why are you worried about inflation? I'll tell you right now, the current inflation numbers are not that big of a deal. Yeah, we had a couple big months, but then last year we had a couple weak months. On net, on a year-on-year basis, if you look at the PCE, core deflator, prices are up by 1.9%. That's Fed target. That's not high. That's normal. That's absolutely relevant. Well, you got to worry about that because of low unemployment rate. That's the big push now, right? Low unemployment rates means more inflation. No, actually falling unemployment rates means more inflation. That's actually a relationship. It's not low, it's falling. And they've been falling for a couple of years with no inflation. Indeed, the entire conversation about unemployment and inflation is still based on this 1970s kind of thinking about how inflation works. You can see on the left-hand side, the blue line there is the unemployment rate, the orange line is inflation. And you can certainly see the Phillips curve in play. That's the negative relationship between unemployment and inflation. Back in the 70s, unemployment would go down, inflation would go up, and vice versa. All the way through the 70s, we saw that. But the thing about the Phillips curve, it's still operational, but the impact of the Phillips curve is critically dependent on the underlying amount of inflation in the system. Right now, I mean, take a last 15, 20 years or so, you can see the relationship between inflation and unemployment, but it's really small. I mean, you've seen an almost 5.5 percentage point drop in unemployment, and inflation's gone up 0.5%. Almost nothing. So the idea that the labor market's going to create inflation, it doesn't make any sense. Now, what determines underlying inflation? The answer is money supply. And here, the numbers say the exact opposite. M2 growth, because the end of quantitative easing, is now 4%. That's the weakest it's been since the beginning of the recession, middle of the Great Recession. Bank lending is still moving a really slow 4% on a year-on-year basis. Banks are important for the money supply because of the multiplier effect. You got slow bank lending, you got weak money supply growth. If I look at these by themselves, I wouldn't be worried about inflation, I'd be worried about deflation. So what's the Fed doing? Well, I don't know. Or maybe they're worried about the stock market bubble. Well, first of all, I'm not sure we have a bubble. Yes, I realize PE ratios are high, but remember, PE ratios are high in part because interest rates are low. That's a financial truism. Equivalently, when PE ratios got high, it's because all these companies were expecting a big tax cut, which they got. Which again seems to make sense that you would see a little higher valuations. The fact that the market's been going sideways means, okay, they built that in, they got it, things are okay. And in any case, as far as I know, the Federal Reserve's mandate is not stock market stability. It's economic stability, which is totally different than stock market stability. If this is what they're talking about, they shouldn't even pay attention to it. It's not in your mandate. Because the stock market doesn't create recessions. Oh, Wall Street loves to tell us, oh, the stock market knows all, it sees all, it leads downturns. Ridiculous. Ridiculous. The stock market sells off in the middle of a downturn because guess what? Corporations are getting hurt in the middle of a downturn. They're losing money because the economy is weak. The downturn didn't start with the stock market. The downturn started something else, somewhere else. As far as leading the economy, go back to 2008. The recession started in Q1. The stock market didn't have its first major sell-off until August, almost halfway in when Lehman went bankrupt. Stock market seemed far more concerned with the stock market than they did with the rest of the economy. In any case, if you're worried about the stock market, why are you doing this? The Fed just proposed a plan to make life easier by loosening the Volcker rule. Folks, listen, between you and me, the last two recessions started in South Manhattan. Okay? It did. The subprime nonsense that blew up the economy started in South Manhattan with the big investment banks. The dot-com started in the stock market with the NASDAQ craziness and all the pumping going on the new economy. Let's be honest here, okay, for just a second. Deregulating the stock market is not necessarily a good sign for the U.S. economy. I'm all for making money, and trust me, I think in terms of Dodd-Frank's and the banking system, you know, I don't know, I still have not quite figured out when the banks became the scapegoat of what happened in the last downturn. They were secondarily involved in this. And reforming that, getting the banks loosened up, to me makes a lot of sense. But the idea that the big investment banks in South Manhattan, where the last two recessions started, that these guys should be deregulated, that one I'm, shall we say, a little bit more dubious about. So my argument, of course, is why are they raising rates? It has to be because of the height of the chairperson. Well, you know this, right? It's all about the height of the chairman. Powell's 5'11". We got to get back to Greenspan rates, right? Now, mind you, this is, of course, ridiculous, but I have a question for you. Can anybody give me a better theory for what they're doing? And this is what scares me the most. The Federal Reserve, an operation that I have respected heartily, I'm suddenly scratching my head and going, what the hell are they doing? And that's never a good thing. Never a good thing. So how about locally? What's going on here? We found this. This is the autocomplete. Everybody ever play this? Put in your state here. California is broke. Nevada is not a wasteland. I like this. Nebraska is boring. I'm sorry. That's what they said on the internet, right? But what is happening around, yeah, exactly. What is going on around the nation we have today? Well, look, from an overall standpoint, standard patterns of growth have reemerged inside the U.S. economy. You know, things have come and go on a quarterly basis. A little slowdown in the West in the first quarter of this year. Texas, the oil states are doing much better. But overall, you look at the last year, the last 5 years, the last 20 years, far west and the Rocky Mountains are on top. You got the Southwest and the Southeast basically kind of in the middle. Great Lakes heating up just a little bit. New England about the same. Mid-East and the plains are slowing down. So you do see these coastal areas kind of growing a little faster. The South, the West, the Southeast doing better. Other places doing a bit slower. But what's interesting here, again, goes back to this idea. When you look at these differential growth rates across states, is it because some states are being hurt worse by, say, trade deals than other states? Is there some differential? Why are some states doing better than others? And for the most part, it's not so much that some states are just better than others. In fact, it's not red states versus blue states. It's not coastal versus inland. It actually has a lot to do with just where people are moving. What's interesting is on the left-hand side here, this is unemployment rates, and on the right is change in total payroll employments for the 9 areas inside the United States. And the lowest unemployment rates we're seeing right now is in West, North Central, and New England, and yet West, North Central, and New England are 2 of the 3 slowest growing parts of the economy from a jobs perspective. So 2 of the places with the lowest unemployment rate have also had some of the least amount of job growth. See, it's not as simple as, oh, they're having a tough time and thus people are leaving. In fact, the opposite. If you look at unemployment rates and job changes, this is across the 50 states, there's no relationship between the unemployment rate and job growth. There are some states that have high unemployment, low job growth. There are some states that have high job growth and high unemployment. There's no real relationship here. What's driving this, of course, is net migration. One of the things about the U.S. economy getting back on even keel, standard patterns of migration have reemerged. People are moving. Where are they moving? Again, Florida, Nevada, Colorado, Oregon, South Carolina, Washington, Arizona. These are places people are moving to. They're moving away from Alaska, Illinois, New Mexico, Wyoming, Connecticut. For the most part, this is not being driven by job opportunities. Wisconsin's a classic case of that. Wisconsin is one of the tightest labor markets in the nation, and yet there's not been very much growth there, in large part because there's a lot of exodus. People are moving out of the state. Younger folks in particular seem to be moving primarily to urban areas, primarily in the West and the South. It just seems to be what people are doing there. And you can certainly see the number here. Overall net migration, where people are leaving. They're leaving the plains, they're moving to the Northeast, they're moving west, they're moving to the Southeast. These are the places that are seeing those strong numbers. That is what's pushing this particular thing. Now, not all net migration is the same. This is some of my favorite numbers. This is the age group of people moving to Arizona and age group of people moving to Colorado. Just a little bit different, you might say. Anybody notice that? Now, this morning, they were doing a little marijuana vote at the thing, and I noticed that Arizona voted against it and Colorado was strongly for it. I think that kind of explains everything on this graph. And I should probably spend a few minutes talking about California, since you're in our lovely home right now. What is going on here? Again, a lot of bashing when, of course, the reality is California's been on fire. 8th fastest growing economy over the last 5 years, 2.6% job growth, economic output growing faster here than the rest of the United States. Well, the bad jobs, people like to say. Again, not so much. In fact, if you look at the numbers, we've added about 1.3 million full-time jobs in the state over the last 4 years, well, from 12 to 16, which is the most recent data we have. Almost half of those are people making over $100,000 per year. California is doing great. We've been doing wonderful. And yes, so lots of high-income households here as well. That's part of our state phenomenon. Well, it's because of the Bay Area. In fact, not too long ago, one of my colleagues here in the state said, California recently grew to become the world's 5th largest economy. Sounds like great news, but that wealth is mostly benefits the very rich and the tech. Almost all income growth and high-end job growth took place in Silicon Valley, they said. And I just love this term because, again, it's one of these preposterous stories with zero factual evidence. When you look at almost 500,000, 100K plus workers this state has added, yeah, the Bay Area is home to a lot of them, there's no doubt about it, 40%. But the other 40% are right down here in Southern California, and of course the other 20% are across the state. There's lots of job growth in lots of parts of the state. The state's doing very well at this particular point in time. But despite all this good news, job growth here has slowed down really substantially. Overall, job growth is now below 2%. And what's interesting is the fastest growing parts of California right now are, and I repeat, Stockton, Fresno, and the Inland Empire. Stockton, Fresno, the Inland Empire. Those are inland parts of the state of California. Stockton in particular, probably well known since its founding city went through bankruptcy not too long ago. Fresno, pretty sure that was Breaking Bad. I remember Breaking Bad, right? And of course the Inland Empire just west of here. Now, I used to hear, excuse me, as the case may be, why is this? Well, it's funny, it's the same problem anywhere else. It's a lack of people. But of course our problem with lack of people is not just national, it's also local, because of the fact that we typically import lots of folks. You look back in the 1970s and 80s, every year California's population expanded by 1%, people moving here. Over the last 6 years, almost none. There's not a lack of opportunity. Unemployment in the state of California has never been lower than it is right now. Unemployment in Los Angeles County, where you are right now, has never been lower than it is right now. Our problem, of course, is we decided to make it completely impossible for people to live here, even if they want to, because we won't build housing. And the numbers really are acute. To average 2% job growth in the state of California, you'd have to build between 210 and 260,000 new units per year. Right now, we're building 120,000. We don't build anywhere close to enough housing, and as a result of that, prices keep going up and up and up, and people no one can live here. And the houses that do come up for sale go for astronomically high prices, not because it's a bubble. Like everybody thinks it's a bubble in California. Why? Because prices are so high relative to the incomes of people who live in that community. To which I point out that is a completely irrelevant statistic. Look, homes aren't bought by people who live in that community. They already live there. Homes are purchased by people who want to live in that community. And relative to those folks, these prices are perfectly reasonable. I know because they're buying them at these crazy high prices. Now, what's interesting about this is in California, all the debate is about affordability. We're talking about reducing the cost of Hawkins, maybe going back to rent control. We're talking about having all sorts of affordable housing mandates, all sorts of subsidies for lower income families. But what's interesting is along with, of course, the housing shortage, we have a labor shortage. And our labor shortage is causing wages to rise faster in California than in any other state in the nation right now. And that is more true for low-skilled people than it is for high-skilled folks. From 2013 to 2016, the wage rate for people without a high school degree in California increased by 13%. Compare that to 9% for people with a bachelor's degree. More jobs, more job opportunities, more hours, and more pay, and this is only through 2016. Talk to anybody working a construction site right now, there is a bidding war for anybody who could carry around 2x4s because there is nobody available. Now what that means is, believe it or not, if you look at the share of rent-distressed households in the state, it's not getting worse, it's getting better. The share of rent-distressed households is falling because incomes are rising faster than rents. We don't have an affordability crisis in California, we have a supply crisis in California. And if you only talk about affordability, you're never going to fix supply. So it is a big problem. It is a big problem. So add it all up. Where are we as an economy? Numbers look great. Going to be 3% plus growth year. We're not going to see another 4% second quarter. Consumers will pull back a little bit. We'll be in the Midland threes. We'll average a little over 3% this year. That's good. It's above what we should be growing at, to be honest with you. Given where we are in terms of labor force growth, 2 to 2.5% is sustainable. 3% is being driven by, of course, the fiscal stimulus. State revenues are going to look positive across the board. Labor markets are going to be tight. That means rising wages, which is good for lots of things, good for consumer spending, good for sales taxes. It's also going to put pressure on profits. It's going to put pressure on the stock market. Exports are going to be steady. Business investment is going to continue to be strong. Inflation is going to be constrained. Interest rates are low. Debt levels are safe. We live in a good world. But of course, there are the negatives. The Fed's tightening for reasons unclear to me. Markets do look a little frothy, and I'm worried about deregulation. Where do we go from here? Forget the consumer savings line. That is now erased, and I forgot to take it out of this. Federal deficit will widen very certainly. Political uncertainties are going to continue to dominate the headlines. Our housing shortage is going to constrain growth locally, and of course all these critical policy issues, whether it's pensions, whether it's Medicare, whether it's infrastructure, none of this is being discussed properly. So from a pure outlook, in the short run, I'm really confident. In the medium term, I'm getting a little scared. Unfortunately, we're not having that conversation. We're worried about the short run, and we shouldn't be. You know, I call it the great disconnect. What we are worried about versus what we should be worried about. We're worried about the number of jobs. We should be worried about the number of workers. We're worried about who pays for health care. We should be worried about what we're paying for. We worry about tax levels. We should worry about tax structure. We worry about income inequality. We should worry about wealth inequality. We worry about funding government liabilities. We should worry about unfunded government liabilities. We worry about business investment. We should be worried about lack of public investment. We worry about inflation. We should worry about slow lending. We worry about the cost of California housing. We need to be worried about the supply of California housing. So one thing I've learned in my years of doing policy work is very simple. If you don't ask the right question, you're never going to get the right answer. And the problem we have is we're asking the wrong questions. We have to start asking the right questions, because only then will you come up with the solutions. But we're not doing that. We're asking the wrong questions, and as a result of that, a lot of policy is moving in the wrong direction. So my ask of you, before we wrap this up, is avoid the weapons of mass distraction. Ignore the tweet storms. Turn off the screaming headlines, and I don't care if they're on CNN or Fox. Turn them off. Look at the numbers. Read the statistics. Get into the data. The answers are there. We just have to have the courage to go look for them. Thank you very much, everyone.
Thanks, everyone.
So I think we have time for questions, right?
Yep.
Yeah.
Is
I don't know
this
how
working?
much, but
Yeah, we have a few minutes left for questions. If anyone has any questions left for Chris. Is this working? No.
I don't think it's on.
Oh. The mic's not working. I guess.
Hey, go ahead. Yeah. All right. Great question. So the question is, sure, in other states we build, but we only build at the high end. What state are you from, if I ask? Virginia. Okay. The answer is that's okay. And I'll tell you why. It's interesting. There's a term in economics we call filtering. And the idea of filtering is very simple. Given the cost of construction, you build at the high end, but by building at the high end, you create vacancies at the lower end. And those vacancies tend to be filled up by lower income households. And, I'll tell you a state that does filtering great, it's Texas. I mean, you look at Texas building, the patterns of building, how they incentivize building, there's lots of new housing, and as a result of that, you're always building a new neighborhood, high-income people move there, middle-income people move their old high-end neighborhood, and so on and so forth. And you see these constant movements within these cities. It's a fantastic example. And I'll give you a great number. In Houston, if you look at housing, say, built before 1970, in Houston, in old housing, 1970, 10% of people living in that housing are making $70,000 or more a year. So 90% of that lower income households. San Francisco, 60% of people living in housing built before 1970 are earning $75,000 more per year. What people don't seem to appreciate is when you cap high-end construction, you actually limit housing for low-income families because you push middle-income families into that housing stock. So building at the top end is fine for these kind of economies. Now, mind you, that may not work perfectly across the board, but we should recognize for the most part, if you open the spigot up and let the market supply, it will handle most of it, and then the actual kind of subsidies and support you have to do remains relatively limited, relatively subset. In California, we shut everything down. We're in a situation, no matter how much money we throw at it, we can never have enough affordable housing in the state because we don't let anything get built. Other questions? I can just yell them out.
No,
we have
There's a lot of discussion about the recent tax reductions for the higher end people and corporate tax reductions.
Yeah.
There's discussion about a lot of that money is being utilized to reinvest, not reinvest in the company, but buy back their own stocks.
Mm-hmm.
Long term, is that a worthwhile discussion? Is that a worthwhile concern? If you follow me.
Yeah, I mean, there's two things we have to talk about, right, here. One is the distribution of income and wealth, and then the other is what I would call investment in general. The thing about investment in general is our investment markets have not been in any way, shape, or form constrained, whether it's because of foreign retained earnings that haven't come back because of tax law or because of taxes on high-income folks. The idea that the U.S. hasn't been investing enough because of these issues is silly. We invest lots. There's huge amounts of money floating around the market. If you want money to invest, you will get it. And so the idea that tax policy is going to have a substantial implication on investment doesn't make any sense whatsoever. As for the distribution of income, again, my perspective is very simple. I'm not so worried about income inequalities. I'm way more worried about wealth inequalities. And so my discussion here is rather than getting pulled into the debate as to, should we be cutting the top marginal tax rate or having a larger earned income tax credit, I would argue let's take a step back and recognize that when fewer and fewer people are controlling more and more wealth because of distortions in the tax law that allow them to build and maintain and carry that money and never pay taxes on it, you have a real problem there because it is inherently destabilizing to a democracy. It just is. And there are ways, I think, of dealing with that. So as opposed to getting pulled into the debate about whether or not they should have done it on the income tax side, I would like to completely focus attention on talking about the wealth side and recognizing that, yeah, people who have billions and millions and billions of dollars, there's got to be some sort of system to kind of get a little bit of that pushed back into the middle. It's just healthy for the long-run health of the economy. As simple as that. And, that's a political economy, not a left versus right kind of phenomenon. This just goes back to the idea that inherently more and more wealth controlled by fewer and fewer people is very destabilizing. Every economy in history has seen that. Oh, absolutely. Our website is beaconecon.com, beaconecon.com. We will have the presentation up there in just a day or so. You'll be able to download that. How am I doing the time? Yes, sir. Actually, I did mention, so the question was, you didn't say anything about the federal government unwinding quantitative easing. I did mention it, although only briefly. And first of all, it's not the federal government, it's the Federal Reserve. Well, it's not, it's an independent agency. And to be clear, the unwinding, I didn't talk about the unwinding of quantitative easing because it's not that big of a deal, except for the fact that money supply growth is so slow, it's creating some deflationary pressures within our economy as a result of that. But otherwise, look, quantitative easing was given way too much credit and or curse, if you will, on the way when it was being created. And it didn't neither one of the above. The vast majority of money created through quantitative easing didn't end up in money supply. It ended up in the form of excess reserves. They got enough money through the banking system into the economy to prevent deflation, to give a little stimulus to the economy, did exactly what they needed to do. Now they're unwinding it slowly. It's a perfectly reasonable policy because, again, most of that flows in and out of excess reserves. It's not real money. It isn't that big of a deal. Candidly, not only is it not that big of a deal, but we also have to recognize that in an era of low inflation rates, quantitative easing is going to be the policy du jour the next time we have a downturn. They don't have the room to maneuver with the federal funds rate to have any real impact. It's going to be quantitative easing. We should accept this as a tool. We know it works. It's not that big of a deal on the positive or negative. It's just a tool in their toolbox. Simple as that.
Thank you. First, full disclosure, I've been coming to these events for 9 years. I'm a senator from Canada. Mm-hmm. This is one of the finest presentations I've ever listened to.
Thank you, sir. I appreciate that.
But I want to touch upon one of your files on myth busting. I want to bust a myth.
Okay.
And you mentioned the production of oil in the state, which is fabulous, and you also mentioned it's not as bad as the tar ponds in Canada. We have no tar ponds in Canada. They're oil sands. If you want to look at tar sands, the La Brea tar pits in LA, those are tar sands.
Okay.
Tar is a coal derivative, not oil sands. The current oil field in Southern California, which is a 20 square mile moonscape of jacks and about 1,100 tailing ponds, that's an environmental disaster. Deal with that in your own home state first. The other point I want to make is when it comes to carbon production.
You know, by the way, we talked outside, and I knew I was going to yell at for that, but this is. But I tell you what, I'm happy to listen to this, and you can school me afterwards, and I'm happy to listen.
Yeah.
But I think you have a question.
Well, I just want to clarify one thing.
No, but
when it comes to the production, if people believe that the production of carbon is an issue, I'm not saying whether it is or not. Canada produces about 1.6% of the world's carbon. We could shut down Canada tomorrow, walk away, turn everything off.
Agreed.
And the production of carbon in
This is not Canada's problem, it's the United States problem. I agree with
the
it.
production of carbon in North America will continue to decline.
I agree.
Thank you.
I agree. Absolutely. Agree to all the above.
I think we have time for about one more question.
I know I had a few people here. You had your hand raised. I can't give you a medium term right now. But again, you know, I honestly don't think, well, look, problems can arise at any point in time, right? New problems. I think you're good for the next couple of years for sure. Medium term is out past 2 to 3 years. Yes, sir. Yeah, well, that's 1 quarter growth. It slowed down just a little bit. It pops back up. It's just ebbs and flows. Those short-term numbers sometimes because they're not the best numbers in the world, so they kind of flop around just a little bit. But some of that clearly is being driven by a slowdown in, if you will, some of the population growth we've seen. But I haven't dug too deeply into it. Look, on a year-on-year basis, California is still growing at a pretty good basis. Year over year, it's still growing at a pretty good basis. Yeah. So don't think too much about 1 quarter. Yeah.
Great. Excellent. Thank you so much, Chris. We really appreciate it.
Thank you very much, everybody. Enjoy the rest of your stay.
And these slides and the audio will also be available on the NCSL website as well as the Beacon Economics website.